Hello, my name is Matt Russell. I'm an FX Power Course instructor here at FXCM. I want to welcome everybody to the daily FX walkthrough. Going to get started in just a moment. What I'm going to do tonight, as always, is walk through the latest technical report by Jamie Setley at DailyFX.com. So let's go ahead and pull up that report, and we can read the synopsis on top. Dollar bearish opportunities across the board. Staying dollar bullish was proved incorrect. The break of the USD support makes it highly probable that a multi-month USD decline is underway. The best opportunities for a risk-reward standpoint are the pound dollar, Aussie dollar, and Kiwi dollar. So let's scroll down to the euro dollar, as that is the trade that I did set up yesterday. The bearish triangle scenario is invalidated, as I was wrong to maintain a bearish bias at resistance the past few days. It is much more likely that a bear rally is underway towards the mid-140s, if not higher. And we can pay attention to this. Resistance is not until the downward sloping trend line, which is at 136 today, and decreases about 23 pips per day, obviously because that is a downward sloping line. So let's scroll down, and I'll get more into that once I do pull up the charts. The next thing I wanted to speak about was the Kiwi and Jamie's analysis. As he mentioned yesterday, he had that resistance line, and Kiwi has rallied through trendline resistance, drawn off September and November highs, making it highly probable that a larger bull move is underway. Major resistance does not begin until 61.37 to 83. So let's go ahead and pull up the charts. And let me move this over just a little bit. And this is the euro dollar that we spoke about yesterday. As I mentioned, that 130.85 area. Prices were just below that area last night. During my report, I mentioned that we can treat a move above that 130.85 area as a breakout, and that's what occurred. I mentioned also that if we had an hourly close above the 130.85 area, that we might enter at that point, placing our stop back below the 30.85 area. We can see that this is a good example of a clear breakout, and also the back test of the former resistance line that then acted as support. And this is a good example of things that we should look for. And I mentioned to enter on the close above. Also, the other alternative for more conservative traders is to wait for the back test. And this is a great example of prices coming back down and testing the previous resistance area, and then it acted as support. And the key point is that your risk reward, if you enter on the back test, is extremely favorable. Because let's say prices come down, and let's say they just break the 131 figure, maybe 130.95 or something like that, you can then place a very well protected stop, maybe 50 pips or so back beneath that line, and we could see the rally that has unfolded. So assuming you did enter on that trade set up yesterday, what I would do now is sort of just hang out and wait to see. Jamie mentioned that downward sloping resistance line at 136 right now, decreasing 23 pips per day. So we might hold. Personally, I might take a little bit of profits up here. This is a 200 pip trade or so. So we might take a little bit of profits just in case prices were to resume the overall downtrend. But as Jamie mentioned, and I'm in agreement with him, that this could be the start of something larger. So at least to that 136 area that Jamie was mentioning. So let's go ahead now, and the Kiwi dollar, and as I mentioned during yesterday's report, the prices started to peak back above this longer-term resistance line, drawn from starting from the late September high, and we did have a close we did have a close above this resistance line. So now I would maintain a bullish bias against this resistance line, which I would now expect to act as support. So as I was mentioning during the euro dollar analysis, right now, let's say you're listening to this report right now and you haven't entered a trade. I wouldn't enter a trade at this moment, only because this is a daily chart we're looking at, and the risk-reward ratio simply isn't there. And what I want to avoid, and a major mistake that traders make, is that they might enter now, a clear technical reason to enter. We had a break of a longer-term resistance line, and that is a very bullish signal. And they would enter here and place their stop at the former resistance line, and they might think that that's going to act as support in the future, which it very well might. But let's say prices do penetrate that line by about 10 or 20 pips or so, then you would be stopped out. Then prices might rally after that point. So what I would do now, assuming, let's say, you entered on that euro trade yesterday, I would wait right now to see if we can get a nice back test of this resistance line, again, believing it's going to act as support in the future. So maybe about 50 or 75 pips below current prices. Right now we have a print of 55.14. So we might wait for another drop, maybe 50 pips or so before entering, and then place our stop maybe 50 pips or so beneath the previous resistance line, which we are now expecting to act as support. Again, my name is Matt Russell. I'm an FX Power Course instructor here at FXCM. Thanks for listening.